Today, we're going to talk a little bit about what's going on in the stock market. We're in the beginning of earnings season. A lot of people have been telling you, throw all your technology stocks out because as interest rates rise, those tech stocks go down. I'm here to tell you why. I've been telling you the opposite. I've been arguing on TV with companies like Amazon, Facebook, Apple, all those stocks that the big Wall Street firms were actually downgrading a few months ago. But now that they're up 20 and 30%, all of a sudden we're getting some upgrades. Let's talk about all that and a little bit more on today's Wealth Talk. So, guys, let's take a look at what's going on out there. We're getting some stocks that are starting to get beat up, yes, in technology land as interest rates rise. The first question is that I want you guys to be educated on and understand is, why do technology stocks not do quite as well when interest rates rise? I'll tell you why. It basically simply comes down to this. When you're discounting earnings, right? Remember, we always talk about on this show, anyone who's involved in my academy, the 10-year bond. As that 10-year bond goes up, it becomes competition for everything, meaning cash rates go up, the rate that you're paying on your bank loans, all that stuff goes up. But if you're going to invest today, right, and you put your money in the bank, you're not really getting anything. Well, what happens when that money starts to go to 2, 3, 4%? What happens if the 10-year bond picks up? Well, then you have competition. So people say when we're waiting for earnings for some of these big technology companies, as long as the alternative is low, people are willing to pay up. But as those interest rates rise, there's now more pressure on those earnings to come forward a lot sooner. And technology companies are investing in the future, right? So they're not going to be paying big dividends and things of that nature. So what tends to happen in those environments is people put money into more of those industrial stocks, banking stocks that typically tend to do well on that. But what I'm here to tell you is the market's changed over the last 20 years, 10 years, 5 years, 2 years, even the last year. The dynamics, mechanisms, and the environment that we're in right now is not like the past. So those who continue to look like at the past to be able to predict what's going to go on in the future are going to be mistaken. And so while everyone's been saying throw out technology, what I've been saying is be selective. So let's talk about this week, for example, companies that I own, my clients own: Facebook, Google, Apple, Amazon just reported yesterday, the stock's up today. All those companies, 40% beats. Apple buying back stock. All these companies are absolutely crushing it. Why? Because these are fundamental technology companies that underline the way we do business today, the way we interact. You guys are watching this either on YouTube, Google, Facebook, my Instagram, all these things, Amazon, Facebook, Google, Apple. All of those companies touch me and most of you on a daily basis. Are these things that you want to throw away if you're a long-term investor? I don't think so. I don't think the thesis of any of those is dying soon. Goldman Sachs months ago said, don't touch Apple. Today they said, we're sorry, it's time to upgrade Apple stock. Guys, you have to stop thinking for yourself because Wall Street analysts have investment banking conflicts. They're trying to make decisions based off of if you're 80 years old, 2 years old, whatever it is. They don't know your individual solution. They don't know what you're trying to do. They don't know what you're trying to accomplish. They don't know how you look at risk. So stop looking at them to give you direction on what you need to do and instead start investing in yourself. That's why I started my Wealth Academy, because I believe each and every one of you that is watching this show, with all the information that's available now, if you have the tools, if you have the frameworks that I teach to be able to digest that information and apply it to you and your own financial plan, are going to do better than letting someone else lead you around. Right? And so we saw companies report. Why did Amazon do good? Why did Facebook do good? Google and Apple. Well, I just told you, these are fundamentally strong companies. In Google, for example, they said, well, it's a technology company. It's not going to do as good when the economy opens back up because you want to be in Royal Caribbean and Carnival Cruise and all those stocks that are going to benefit. Well, why don't you do some research and understand that the vast majority of the profits a few years ago from Google advertising was coming from travel and tourism related advertising? Well, don't you think that that's going to actually benefit Google as it opens up? Don't you think these are going to be the things that kind of work out? Don't you think that people that have been upgrading iPhones, all of a sudden you're going to start to see that play out in Apple earnings, guys. This is not rocket science. So stop letting people tell you who are making decisions based off of, their job security over the next 3 months, what to do for long term. I personally own all those stocks that I've been talking about for years now. I use opportunities when you get names like Apple that sell off because people are panicking and don't understanding things to buy more of those. If you have a long-term time horizon and you're not worried about day-to-day fluctuations, sell-offs are good opportunities for you, right? So you've got to, a few things that I want to talk about here is you've got to understand first and foremost that there's no one who's going to be able to give you better advice and make better financial decisions for you than you being educated, right? Stop looking at the guys who you think are smarter than you to tell you what to do. Because also what I could tell you in a market like this where you're going to see some volatility, I believe, in the next few months, if you don't have conviction and understand what you're buying, you're going to be just like the average investor. And what does the average investor do? They constantly buy high and sell low. They buy when everyone feels good about things, everyone's dancing in the street. And then all of a sudden, when people sell things off, they think, well, what do those people know that I don't know? And they sell. And that's just an absolute calculation. It's a roadmap. It's a menu for losing money time and time again. Good investing, as I say, is counterintuitive. Know what you're doing, know what you're buying, get your shopping list ready. When everyone else panics, you buy. When everyone else is bidding things up that doesn't make sense, that's when you start to take a look at those. I talked on Fox. You can look yesterday at my clip about Coinbase. When that stock came out, I said, wait, guys, be patient. It is a great company, but you have to separate great companies from stock prices. And I said, there's going to be a lot of euphoria. That stock jumped up into the 400s. I had people DMing me, hey, I bought in the 400s. I went on Fox and said, start to look at it fundamentally in the 270s, 280s. That stock is now under 300, hit 282. Why did I do that? It's not because I'm prophetic. It's not because I have a crystal ball. It's because I understand valuations. I understand market psychology. And that's what I'm trying to teach people. That's why I'm doing this free on YouTube. So you could start to understand that you have to educate yourself. And so all technology, again, I wanted to go back to that point, is not created equal. Look at Pinterest, look at eBay. Those companies got pummeled down 10, 11%. Why? Well, think about it. Is Pinterest part of your daily life? It's not part of mine. eBay used to maybe be something I looked at once a week ago, like 10 years ago. One of the best parts of eBay that I used to like the stock for was PayPal, but PayPal sold off, spun off to its own stock now, which owns Venmo. I'd much rather own companies like that are relevant today versus eBay. Right. And so what happened was those companies got a boost during the pandemic. We're all home scratching our heads, bored to death. Yeah, we're looking at sites like Pinterest, building our catalog for what we're going to do when the world opens back up. Right. So that doesn't, surprise me. But what people want to do is point to names like that and say, I told you to get out of technology. Meanwhile, the obvious companies, Amazon, Google, Facebook, Apple, all those are skyrocketing. So again, a couple things. Do your homework. Don't believe the hype of, technology is not going to go anywhere in a rising interest rate environment, because I'll tell you what else. We're getting all this infrastructure spending out of the current administration. Who knows how we're going to pay for that? More than likely higher taxes and all kinds of other nonsense will continue to print money. But at the end of the day, these companies that are benefiting, these infrastructure types of stocks, well, if you look at the valuations on some of those that everyone calls the value stocks, they're actually starting to get more expensive than a company like Google. And so while they'll be able to get good growth because the government's handing out free money to them right now, what about a year and a half from now? What about 2 years from now? Is that really where you think the growth is going to come from? More than likely not. Technology will, look at these companies that are, some of them are already trillion-dollar companies beating 40%. Technology, guys, is the future. And if you're a young investor, do not let people talk you out of it. Do your own homework, obviously, on individual names, but do not abandon what's growth, because when that stimulus wears off, guess what investors are going to look for? Growth. And where are you going to get growth outside of technology when the whole world is changing right now? You're not. So I wanted to put this out today because we're in the middle of earnings seasons. A lot of people are telling you to sell off some of these companies that you believe in long term. And I want you to have conviction, if you're a long-term investor, not to get persuaded by them. And to also realize when you invest in individual companies, you can invest in companies that will do good in a same sector that companies are doing bad. And doesn't that make sense? When companies have competition, right? Some are going to go out of business. Blockbuster's still around. Circuit City went out of business years ago. You guys remember Home Base? I do. I used to work there as a teenager. Home Base is gone, but Home Depot's still around. So it makes sense that there's going to be winners and losers. Netflix, buy Blockbuster, they're gone. Just because a stock trades in the same sector does not mean that it has to go down or up together. Long term, the cream tends to rise. So by doing your homework, plugging your ears when you hear people downgrading Apple at $80 a share and upgrading at 130, and having your own conviction is what's going to get you to build generational wealth. Educating yourself is the first step. And once you have that education, you have the most important component that all good investors have: conviction. Happy Friday. Thanks for listening to Wealth Talk. Share this with a friend. If you want to hear about something different, drop me a line. I do this every Friday to inspire you guys to be better investors, to be better stewards of your own wealth, and to create a financial legacy. Have a great week.